Welcome to the deep dive. Today, we're zeroing in on share buybacks.
Right. Kind of an alternative way companies return value to shareholders, maybe flies under the radar compared to dividends.
Exactly. And we're digging into an article from The Motley Fool, two stocks crushing it with share buybacks.
Good source for this.
So the mission today is really to get a handle on how these buybacks work and, look at two companies the article highlights as doing it effectively.
Yeah, I mean, dividends are straightforward, right? Cash in your account. Buybacks are a bit different, but potentially just as powerful. This article gives us some great real-world examples.
Okay, let's dive right in then. First up, AutoZone. Ticker AZO.
AutoZone.
Their business model always seems a bit, well, it feels like what's bad for my car is good for them. The article kind of touches on this.
It does. It's that counterintuitive thing. When cars need fixing, especially if people decide to do it themselves to save money.
They head straight to AutoZone for parts.
Exactly. So older cars on the road, maybe a weaker economy, pushing DIY repairs that can actually boost their business.
Which is why people call it a recession-proof stock, or at least recession-resilient. Cars always need maintenance, right?
Pretty much. That need is constant.
But beyond that resilience, the article highlights something pretty dramatic. AutoZone has cut its share count roughly in half over the last 10 years.
Yeah, by half. That's huge. The article mentions a graph showing this trend, calls it a beautiful X.
A beautiful X. Okay, explain that. What's the impact of slashing the share count like that?
Well, think about earnings per share, EPS. If the company's total profit stays, let's say, steady, but there are fewer shares.
Then each share represents a bigger piece of that profit.
Precisely. So EPS goes up, and that often helps push the stock price higher over time.
Makes sense.
And that X graph likely shows the number of shares going down sharply on one line, while the stock price, historically, has trended up on another line, crossing over. It's a visual cue.
Okay, got it. And it's not just the fool saying this. They quote Andrew Choi from Parnassus Investments. He calls AutoZone a defensive, resilient distribution business and sees potential for earnings acceleration even if the market isn't fully valuing its growth durability.
That's a strong endorsement. It suggests the buybacks are layered on top of a fundamentally solid business.
And it's ongoing, right? The article says they cut shares by over 3% year over year just in the most recent quarter.
Right. So it's not ancient history. It's a current strategy they're actively pursuing.
Interesting, too, how they seem less bothered by things like tariffs.
Yeah, the article points to their high margins, their expensive supply chain, and the fact that people need these parts gives them some insulation.
Less exposure than maybe, say, a global manufacturer.
Definitely. Their focus is more domestic aftermarket. It helps.
Okay, let's switch gears. The second company, General Motors. GM.
Okay, GM.
Yeah.
Another household name, obviously.
And also deep into share buybacks for years now. The article says it's given the stock a significant boost. What are the numbers looking like there?
They're pretty staggering, actually. Between 2023 and 2025, GM announced plans for about $16 billion in buybacks.
It's $16 billion.
Yeah, and remember, their whole market cap is somewhere around $45 billion.
Wow, so that's a huge chunk.
A very significant chunk. And then on top of that, they just authorized another $6 billion.
So the commitment is definitely there. But the article does draw a contrast with AutoZone regarding resilience. GM is different.
Yeah, quite different. GM's fortunes are much more tied to the overall economy, consumer confidence, big purchases like new cars.
Things that slow down in a recession.
Right. And tariffs are a bigger potential issue, too. They import vehicles, use foreign parts, so those potential 25% tariffs next month could hit them more directly than AutoZone.
Okay, so different risk profiles. But the article stresses that GM's buybacks aren't happening in isolation. They're alongside a thriving core business.
That's the key context here. It's not like they're struggling and just trying to prop up the stock price.
What does thriving look like for GM recently?
Well, for 2024, they reported 9% full-year revenue growth. They actually led the U.S. auto market in total sales, retail, and fleet deliveries.
Okay, that's strong.
And they doubled their EV market share in 2024 as well. So there's real operational success underpinning these buybacks.
So looking at both AutoZone and GM, what's the main takeaway here about share buybacks?
I think the big picture is that while, dividends get a lot of the attention, buybacks can be a really effective way to return value.
But there's a catch.
Well, the tricky part, as the article notes, is the timing. Doing it at the right price.
Meaning management thinks the stock is actually undervalued when they buy.
Exactly. That's the ideal scenario. It sends a positive signal and maximizes the value for the remaining shareholders. It's not just about reducing shares, it's about doing it smartly.
And both AutoZone and GM, despite their differences, seem committed to this strategy long term.
Yeah, the article suggests it's a consistent part of their financial playbook, and investors have been seeing the benefits, and likely will continue to.
So, as we wrap up this look at AutoZone and GM's buyback strategies, maybe something for our listeners to chew on. What really defines that right price for a buyback? What factors should a company weigh? And maybe more importantly for us, how can investors judge if a buyback program is actually smart and adding value or just, financial engineering?
That's the crucial question, isn't it? Maybe take it a step further. Look at the companies you own or follow. Are they buying back shares? Why? How much? And what are the results? Comparing different approaches really deepens your understanding.